China was mentioned 28 times on Nvidia's earnings call. The shares, by the way, are at their session lows, for what it's worth, still up about 2.7%. But mentioned almost as much as China last night was the word inference. Deirdre Bosa is here for Tech Check to explain why that was no coincidence and why it unlocks a new growth engine. Deirdre.
So, Kelly, you're right. China took up a lot of the air last night and today, but inference, that's the quiet and maybe even more durable driver of NVIDIA's next leg of growth. Now, here in the Bay Area, the discussion centers as much around tokens and the explosion of AI usage. That has to do with a major shift in the race at large. Early on, it was about training models, building the brains, but right now, that is shifting to using the models in the real world. That's inference, and it's where the next wave of demand is certainly building. We see that through many different ways. It's every time that ChatGPT or Elon Musk's Grok or Google's Gemini answers a question, or every time an agent reasons through a task. Behind every response is a stream of tokens. These are small chunks of text the model reads, processes, and generates. The more complex the task, the more tokens that it consumes. And it's only getting more compute heavy. New reasoning models, they think through answers step by step, rechecking their work, and that translates into more tokens per query running through NVIDIA's GPUs, which are still dominant in this area. On the call last night, NVIDIA said that Microsoft processed over 100 trillion tokens in the first quarter, representing a 5-fold increase year over year. And at Google I.O. last week, I showed you this chart before, it represents token usage, and it's parabolic. Now, as both companies and others incorporate AI into tools that touch billions of users, NVIDIA gets more of this inference, more tokens, more demand, creating this sort of cycle that adds more compute power. Then you add in sovereign AI, Kelly, which we talked about yesterday. That's another leg of that demand. And the China gap maybe gets a little bit less overwhelming, replaced by inference, and that is the growing need to run AI.
It's like the very sophisticated version of Dave & Buster's.
The stock of Nvidia fell almost 3% on Friday, following U.S. President Trump's assertion that China had completely broken a deal with the U.S. At Friday's market close, the S&P 500 remained unchanged, while the tech-heavy Nasdaq dropped 0.3%. The bad news is that China has completely broken its agreement with the United States, which may come as no surprise to some. Trump stated this on Friday morning. "You wasted your time being Mr. Nice Guy." The Trump administration is preparing to increase trade restrictions on China's tech sector, Bloomberg reported Friday midday, adding to market concerns over a resurgence of U.S.-China trade tensions. After U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng met in Switzerland in mid-May, the two nations decided to temporarily lower exorbitant tariff rates. The U.S. lowered its tariffs on China to 30% in what the White House referred to as a historic deal, while China lowered its tariffs on the U.S. to 10% and consented to halt or eliminate the non-tariff actions. However, Bessent claimed in an interview late Thursday that trade negotiations between the U.S. and China were somewhat stopped. In an interview on Friday, U.S. Trade Representative Jamieson Greer repeated Trump's remarks that China is slow-rolling its compliance, but he did not elaborate on how China had broken the preliminary agreement with the U.S. Since the majority of NVIDIA's chips are made in Taiwan and then assembled in servers in that nation or Mexico, the company was largely unaffected by the import tax on Chinese goods that was implemented in April. However, the Trump administration recently banned the sale of its chips to China, which cost the company $5.5 billion. For the Chinese market, NVIDIA produces H20, which are customized, lower-performance variants of its Hopper AI chips. This week, NVIDIA disclosed in its most recent quarterly earnings report that the ban cost the company $2.5 billion in sales in the first quarter, and that it anticipates losing an additional $8 billion in the second quarter. In a note to investors on Thursday, Gil Luria, an analyst at D.A. Davidson, stated that until the Trump administration finds a solution, China will continue to be the biggest overhang on NVIDIA stock. One of NVIDIA's largest markets is China. According to Jensen Huang, CEO of NVIDIA, the company does not currently have any new products planned for the Chinese market. After the company's earnings report on Wednesday, he told analysts, "We don't have anything at the moment, but we're considering it. The restrictions are obviously rather strict at the present, and we'll talk about that with the Trump administration when the time comes. We continue to believe that the China opportunity will at least partially recover." Morgan Stanley analyst Joseph Moore wrote in a note to investors on Thursday, NVIDIA's stock was on pace to record a gain of over 3% for the trading week, despite Friday's decline. Nvidia's stock increased 3% on Thursday after the AI chipmaker revealed first-quarter revenue that exceeded Wall Street's forecasts in spite of challenges relating to China. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Gina, I don't know if you just heard that report from Christina as well about sort of the government looking to do more Chinese export restrictions for the chip design firms, but there clearly is a plan here to restrict China business. And we heard from Wang himself last night kind of reiterating why he thinks American companies should play a role over there.
Yeah, Kelly, that was the subcontext to yesterday's call, was this narrative that Jensen had. He was almost selling to investors about why the White House should be more favorable to NVIDIA and why he's doing a great job of trying to navigate that. And he really centered it on two pieces. The first is related to how they're bringing more core manufacturing, advanced manufacturing back to the U.S., of course, working with partners like TSM to do just that. And that's really critical for the White House because Trump has this belief that in the future that we need to have that critical tech built in the U.S., that we can't rely on our allies as much. And of course, much of that comes from China. And so that was one piece. And the second, he had this comment about trusting the president and that he has a vision and a plan, and I believe in it, and I trust that. And so when I think about the conversation that you had with Christina before this about what's going on with kind of the software curbs getting put in and what it means for NVIDIA is ultimately is the White House is slow playing this. But keep in mind that what matters more than bringing chips back, keeping AI out of the hands of China, what matters more for the White House is the economy. And I'm basing that on a conversation I had on Friday with a high-level former U.S. trade official and really emphasized that the importance of the economy. So in that case, I actually believe that Jensen, reading between the lines, he actually sees on the horizon some sort of resolution where ultimately that whether it's with Synopsys or what's going on with NVIDIA, that these curbs can be kind of pulled back as a point of a negotiation piece for a broader trade deal. I mean, it would make a ton of sense. That would be a big win for China. And ultimately, they're going to probably get some of this tech in some form or the other, whether it's home built or from somebody else, and might as well have a U.S. company benefit from it. And so there's a lot there. I think that the punchline here is I'm optimistic that we're actually, despite the headlines seemingly getting worse around China, I actually think by year end, this is going to sort itself out.
Yeah, if you're right, this would be a huge tailwind for them because you said, you know, if not for the China curbs, their April revenue would have exceeded the street by 8%. They took about a 15% hit to overall revenue. So if you think this gets fixed, you add that back in, plus you have Middle East demand, plus you have, continued demand here in the U.S. It all sounds great, frankly. But is there a chance the Chinese are going to, look at this and say, look, even a 6 to 9 month period is plenty of time for us to continue to try to make headway with Huawei and others and kind of turn their attention towards investment there instead of in the U.S. companies like NVIDIA?
I mean, that's something that's clearly on the table. I just want to kind of test and push on the numbers there a little bit, is that if you look at where the street's at today, the changes to numbers broadly took the China H20 and kind of this low-end chip, whatever it might be, out of the numbers for the next 4 quarters. And so I think you have this opportunity where if, in fact, things do turn to the positive, that would be an unlock. And so I think the numbers have largely been de-risked. And there's this conversation about curbs in China. And I just want to put just the emphasis. You mentioned that 8% kind of upside to the estimates, the guidance relative for July, just so your viewers can get a sense about how big this was, is that over the past 3 quarters, they've raised guidance relative to where the street was at on average by 2%. And so we're talking about a major acceleration. I mentioned that in the context of the China conversation. What happens there is there's something much bigger happening here. And the much bigger thing is the AI build-out is much earlier than what even I, who am optimistic about this, had anticipated. The hyperscalers are still only about a third of the way through. If you look at companies, industries, sovereign, that really hasn't even begun. And so I think regardless of what happens with all this trade in China, The reality is that if AI has the potential that I believe, we're going to be talking about strong growth rates for NVIDIA for the next few years, much longer than people anticipate.
A trade war won't be enough to halt NVIDIA. The Apex AI ticker surged through the tech sector's malaise and delivered in yet another outstanding performance. But the quarterly beat also came with a warning. The company would miss out on $8 billion worth of H20 chip sales in its second quarter, due to tougher export limits. The risks of doing business with the country's economic rival, this time from the demand side rather than the supply side, such as Amazon and Apple, are initially highlighted by the missing revenue. Trump is expanding on a Biden-era policy to restrict China's access to U.S. technology. NVIDIA must therefore forgo billions of dollars in possible sales. However, it can be advantageous to be caught in the midst of global turmoil. NVIDIA's deficit might quickly become an advantage if Beijing and Washington negotiate the next round of their tariff ceasefire. In the larger China trade war, the chip restriction may be used as a negotiating chip. Wedbush analyst Dan Ives wrote in a note on Thursday that the $8 billion run rate could easily come back to the NVIDIA story. The ongoing U.S.-China negotiations could yield positive results for NVIDIA over the coming months that could get NVIDIA back in the China H20 game with a new restricted chip. China still wants chips, after all. Jensen Huang, the CEO, is also saying the right things. He characterized the export restrictions as a failure of policy and praised the company's intentions to produce its AI chips in the U.S. Huang claimed that rather than hindering China, it will hinder American national security interests and stifle NVIDIA by preventing it from participating in a sizable AI market. Although Jensen is aware that his business is enmeshed in the China tariff storm, he may be able to creatively avoid it. A Magnificent 7 earnings season that mostly exceeded projections is punctuated by NVIDIA. However, their tickers, which are mired in the back and forth of trade policies and have most of them in the red for the year, provide a more complex picture. Though they continue, stories of transformative AI development and growth have not been spared. While there are real, costly risks to being pushed and pulled as part of global trade deals, there is a clear path for NVIDIA's problems to simply disappear. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
What have we learned from NVIDIA's results, its guidance, and actually everything that built into it? Because it felt as if we were getting a pretty decent picture thematically about where we are in this phase of AI.
I think it was sort of the culmination of a lot of things we've been hearing from all the AI hyperscalers for the last quarter. I mean, we've continued to hear this reiteration of we're going to spend, we're going to build. Meta raised its CapEx guidance last quarter, and now I think we're seeing it play through in NVIDIA's results last night, where even though we had this noise about China and how much could that impact mean, they still, I think, guided up, if you sort of parse the China stuff out, about 5%. And to put that into context, look at the last year of their sort of raises post-quarter, and they've generally been kind of flattish to 2%. So this was a pretty strong quarter over the history of what's happened more recently for NVIDIA.
And what else are we coming to know about either uptake, usage rates, how many iterations we're talking about, how clients are using this stuff, or is it just still in, look, headlong build data center mode?
I think it's mostly sort of this headlong build data center mode. But what I would say is, I mean, in Intelligent Alpha, we're actually building on this technology. So we're using all of the major large language models to do our stock analysis and portfolio creation. And I'll tell you what we're seeing is that every other week, it feels like, a new significant model release happens, and we have to kind of go and update how we use the technology. Because the updates are significant enough where we can do new things every other week. And so I think for us, we're happy to spend what we spend with the model providers. And I think they're starting to see more companies like us, and certainly individuals, OpenAI, adding 100 million users every month, it feels like right now, that are spending money as well.
Are there now kind of these sort of spin-off and knock-on plays that are worth looking at the moment, or is it still just kind of the obvious beneficiary?
For our perspective, I think semis is probably still the main place to be. And it's funny, the beginning of the year, there was this narrative about software. This was going to be the year for kind of AI and software. It just hasn't happened. I mean, you look at some of the companies, even ones that we own in our Livermore ETF, Adobe, team, Atlassian, they haven't really shown that acceleration from AI yet. But I think that probably still will happen, but it might still be 6-12 months away. The semis are going to keep seeing this more immediate spend.
And then within semis then, I mean, obviously we're showing, NVIDIA, Broadcom. I mean, really over the last couple of years, that's been where the upside has come. I know Marvell's going to report after the close. I mean, is there something else to be gleaned from what they say?
Maybe. Marvell, we have also in our Livermore ETF. That's one I'm a little scared kind of going in tonight, to be frank about it. The concern there is just there's been this constant sort of question about, are they going to lose some of their Amazon business on the custom chip development side? Right. And if we get a firm answer, and there's been sort of reports that they may have lost that, if we get a firm answer tonight, the stock might be ugly. I think you expand your horizon and you say, are there other opportunities for Marvell? I think there are, and so that's a name that we still do own despite that concern.
You mentioned how Nvidia has managed to kind of completely plug the gap, almost, if not entirely, of what might have been lost in terms of China. You also have these other sovereign, AI plays. What is this going to ultimately lead to? Is it going to just be all these parallel models and just, not one global standard? It's going to just be a lot of different kind of versions of this thing, or can we even say yet?
I think it's probably a little too early to tell. I think certainly we've always seen in technology that you tend to have winner take most outcomes. And I think the same will be true in the model wars. I think you could see a general winner in the closed source battle, which looks like OpenAI right now. Google maybe is in the race, Grok also. And then you'll probably have a winner in the closed source space, which Meta is trying to deliver with Llama. Then you look at the countries, right? And each country, I think, wants to have influence over how these models are going to function. So whether that means they create a variant, perhaps, of some of these models that's more localized and trained on specific data there, or they use some of the open source models, I think that's kind of what it looks like. So you might have some big winners and then they spider web out into these other applications.
China produces the majority of the world's solar panels and batteries. The U.S. and its allies maintain a narrow lead in advanced microchips and AI. And autonomous vehicles have rolled out on the streets of Wuhan and Beijing at a pace that Waymo and Tesla have yet to match. The U.S. has tried everything to win the tech race against China, including in areas as diverse as AI, energy, autonomous vehicles, drones, and EVs. To date, none of it has succeeded. White House officials and their proxies are almost unanimous in favor of choking off China's technological advancement by prohibiting the export of AI microchips and the tools to make them, while some outside the administration, such as the head of Nvidia, 2.92% decrease. Red down pointing triangle, say such policies are backfiring by accelerating China's development of its own tech ecosystem. The result is a heated debate between senior leaders in the current administration and critics outside of it. The main question is whether it is better for China to rely on U.S. technology, or if the national security risk of China possessing our technology is simply too great. Jensen Huang, the CEO of the American semiconductor giant Nvidia, is one of those who is intensifying his criticism of the present export restrictions. He said that a new limitation on exporting advanced AI processors to China will cost his firm $50 billion in 2026, which China might spend on AI chips and servers. Hong reiterated his criticism on an earnings call on Wednesday, claiming that protecting Chinese chip manufacturers from American competition only serves to bolster them internationally and devalue America. Export limitations have encouraged China's scale and innovation. Nvidia's limited access to China hasn't had much of an impact on its earnings thus far. When US-made chips are no longer available, China is relying on chips designed and produced entirely in China, such as those made by Huawei, Cambricon, CXMT, and Semiconductor Manufacturing International Corporation. Although each of Huawei's most recent Ascend 910C AI chips is only one-third as powerful as Nvidia's, 5 times as many are packed into each of the company's Cloudmatrix 384 AI supercomputers. In terms of raw power and the crucial metric of how much memory is packed into each Cloudmatrix computer, Huawei is already surpassing Nvidia. Additionally, even though Huawei's Cloudmatrix 384 uses 4 times as much electricity, China has a significant advantage in terms of energy production, according to Doug O'Loughlin, an analyst at SemiAnalysis who has studied Huawei's new AI supercomputers. He adds that China has been increasing its energy production for the last 10 years and has the whole supply chain in place to keep doing so. Despite using older pre-export band technology, SMIC, the company that manufactures Huawei's processors is currently the third largest chip manufacturer in the world and has innovated in the production of high-quality chips. According to Brian Barak, a China specialist at the Heritage Foundation, a conservative think tank based in Washington that has a big say in the present administration, export restrictions on technology like artificial intelligence are more crucial than ever because the United States is engaged in a new Cold War. Barak says his time on the National Security Council solidified his beliefs on the subject. Barak was a member of the council until last week, when 100 employees were let go. According to Barak, even if it's a profitable venture, are we willing to assist China in developing dual-purpose AI that can be used to find targets for guided weapons? China has repeatedly copied and bought advanced technology from the United States, then built it into massive corporations. O'Loughlin compares this to a kid duplicating someone else's schoolwork. I seem nearly anti-business saying this, but I just can't convey enough that we shouldn't make their work easier, he continues. Washington has long been concerned about China's technological advancements, but industry insiders claim that efforts to impede its advancement really took off during President Trump's first term. Due of national security concerns, then Commerce Secretary Wilbur Ross cut off ZTE, a Chinese telecom corporation, from U.S. technology, including microchips, in 2018. This essentially put a stop to the Chinese government-affiliated company's global aspirations. According to Dan Wang, a research scholar at Stanford University's Hoover Institution, the U.S. government showed China's government and tech businesses that it had the power to kneecap China's top leaders at will. A series of software and hardware restrictions ensued, particularly for Huawei, the massive Chinese telecom and smartphone company. According to Rui Ma, a Silicon Valley-based angel investor and China tech analyst, even Chinese tech companies at the time were unwilling to purchase domestically made chips because they were inferior to American-designed chips made in the US, South Korea, and Taiwan. With no other choice, China's tech companies were forced to purchase local, which sparked massive investments by China's tech companies and its government. The more advanced China's chips became, the more the US tried to impede China's progress, including by prohibiting the export of chip-making materials and machinery to China. However, this does not imply that China's domestic chip-making ecosystem is equal to what the US and its allies can muster. But according to Patrick Moorhead, a semiconductor industry analyst who spent 11 years as an executive at AMD, the notion that it is far behind, or will remain so forever, is incompatible with history. In my 30 years in the tech industry, I've seen a lot of people say, "Oh, China won't figure this out." He continues, "I think the only thing left to wonder is when they'll figure it out." According to him, China may eventually be able to source all of its requirements domestically, matching or even surpassing the capabilities of firms like Taiwan's TSMC and the United States-based Intel. According to the experts I interviewed, China possesses a special set of resources that no other nation has ever had in the history of the American trade battles. From highly qualified factory workers to engineers educated at the nation's colleges, its enormous populace is remarkably well-trained. Huang of Nvidia has stated time and time again that China is home to half of the world's AI engineers. U.S. lawmakers recently criticized Nvidia for establishing a new engineering facility in Shanghai. Additionally, it has a sizable domestic market, which allows it to nurture businesses there before they expand internationally. Furthermore, although China still depends on the United States and other countries for a large number of specialized goods and raw resources, these reliances are decreasing as a result of the Chinese Communist Party's persistent, well-funded, and well-organized campaign for independence. Every year, a larger percentage of the nation's needs, from the largest cargo ships to the smallest chip components, are produced. Wang claims that in the best of circumstances, the United States would have permitted its leaders in chips and software to maintain their dominance in the Chinese home market. However, since export restrictions put in place years ago have prevented that, maintaining, and perhaps strengthening, the controls may be the only sensible course of action. According to Wang, the current answer is the seventh best one rather than the second best one. It is undoubtedly impossible to rebuild confidence with Chinese businesses. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.